I hope you have had your coffee, your tea, you're feeling energized for the conversation we're about to have. I'm happy to be joined here by some two experts, and we're going to be talking about a conversation that is very important, and especially under the theme that we have today here at Jasiri Network Summit. So, cross-border entrepreneurship, building and scaling ventures across Africa, a topic that sits right at the heart of the summit's mission. And I am grateful, as I said, to be here. I'm your moderator. My name is Mwathi, and I'd like to give our panelists a chance to also introduce themselves and get to let you know a little bit more about what they do. So if we could kindly start with Dr. Moka.
Thank you, Charity. Good morning, everyone. Yeah, I'm Dr. Moka Lantum. I'm the CEO of CheckUps. I was born in Cameroon, and the one thing that I did, and of all the kids in the family, my parents insisted I go to local university before going abroad, which was a big advantage compared to my siblings, because I got a chance to really, it's in university, in campus, that you really understand how your country works. So I had that opportunity, and then I was fortunate to have a scholarship to study in Sweden and the US, and then worked for a Fortune 500 company, and decided in 2011 to come to Kenya to set up a business. So I really want to underscore the fact that I'm looking at the diaspora conversation from somebody who left a career as a director. I became a manager at Eastman Kodak Company at the age of 24, and I was on the diamond track to senior leadership. So I have had the opportunity to sit on the other side of the fence in a big office and the convenience of a routine salary, and I decided to come to the Kenya market, not Cameroon, and I would happy to talk about that. And we built CheckUps, which is an alternative insurance company. We're doing healthcare financing to enable households and businesses that can't afford outpatient insurance access insurance via WhatsApp. So that's what I do, and I'm certainly happy to be here. But one last thing before I hand over, really just want a big shout out to Nancy and the Jasiri team. We were in London with Nancy, and Nancy pulled no stops to get us access during the London Tech Week. If you've been to London during the London Tech Week, it's crazy. And we were able to get into spaces and places which I would say we would not have been able to do so on our own, and meet some of the giants in AI, thanks to the work of Jasiri Network. So I believe in what the network is doing, and very happy to be here this morning.
Yes. Thank you so much, and good morning, everyone. My name is Sandeep Main. I'm a tax partner with KPMG in East Africa. I also double up as the head of private enterprise for KPMG in Africa. So a bit of an inverse story. I didn't know we were talking about where we were born, but I was born in Kenya, very much Kenyan. But my family had a family business, and I think when I saw how the regulatory and operating environment is, including going to different jurisdictions, that is what pivoted me from being an entrepreneur to being an advisor, and that's what I've been doing at KPMG now for 15 years. But before that, I was in statutory audit, helping businesses adhere to governance, and I think that's a really, really important conversation. So I'm going to keep it short at that, and I'm really happy to be here. So thank you so much, Jasiri, for having us.
Thank you so much. So I'm very glad that you've mentioned your experience in working in more than one African market. I wanted to ask you both to share what has been some of the challenges or insights that you have experienced in your working.
Okay, so I'll go first. So like I mentioned, I handle private enterprise, and private enterprise, unlike the mainstream KPMG that deals with predominantly multinationals, we deal with a lot of startups. We mentor them. We work through their thinking or their sandboxing. When they want to go to different jurisdictions, help them connect them to funders or investors, and also investors to now these startups. I think for me, the biggest challenge I've seen, and I'm not leveraging just on my expertise, which is tax, but a critical area here is really governance and understanding the tax environment of that other jurisdiction, and even locally. A lot of founders, at least 99% of them, are very switched on how they want to do business. They know this is what they need to do to achieve an X10 or X20 times return, But as far as elements of governance and compliance, dealing with revenue authorities is concerned, we are like, you know what, we'll deal with that when we get there, So I think for me, that has been a critical lesson. So it's not always about money. I have seen startups that have raised significant capital, but have still gone bust. Governance structures is what I've seen is really, really critical over and above the funding. And again, the product that they're selling. So you could be in services or goods, and you want to go cross jurisdictional. I think for you, it's really important to understand, is that market ready for my product? So Kenya could be ready for a product, but maybe Tanzania is not, maybe Nigeria is not, maybe Uganda is not. So just getting that market research done, and I caught a bit of the previous panel on DIYs. Founders are experts at DIYs, and I think with technology like ChatGTP and Gen AI and all this, it's very easy just to ask it, hey, would this product be relevant in, say, Nigeria? And it'll tell you, this is great. Try asking it. Ask it again, are you sure? And then it'll be, you know what, you're right. Not really great, but maybe. So it's always good to have an advisor on board just to give you that human factor. So I think for me, those are some of the challenges I've seen with working with different businesses and entrepreneurs across border.
Yeah, thank you, Charity. I would like to make it a little personal, if you allow me to. This is my third company. CheckUps is my third company. The first one we started in 2011 and we exited in 2016. The second one we shut down after 18 months. And the third one, now we're celebrating our 7th year. 533 jobs created. And we have more than 200 corporate customers that we've been able to build a relationship with. Now, to get to that point, the one lesson I'd like to share with you is that when we look at the African market, the first mistake or the convenience mistake we make is to decide to design products or solutions based on need, as opposed to based on solving a problem. And in the space of healthcare, I meet many people, I want to build a hospital. The healthcare shortage in Africa is this. And the question is that, well, those already are operating on the ground, right? They are not yet profitable. So what makes you think that, by just building another hospital, you have the path to profitability? And that applies for almost any business sector, that you believe that, there is a need, that means there's a business. And so you spend a lot of capital trying to design a solution for the need as opposed to solving a problem. I'm a big believer of the fact that if you're solving an African problem, it's very scalable. If you're solving an African need, it remains local. In the case of healthcare, it took us about 5 years to understand the problem we're really having in our hands. The assumption is that, there are not enough doctors, there are not enough nurses, or the cost of care is too high. Yeah, all those are relative truths, yes. But the real issue, in my opinion now, what the real problem is that because of the way money flows, 7 out of 10 Kenyans cannot afford a prescription because of the way money flows. And I'm saying that with a huge reverence to the fact that if you've been in the diaspora market, you are used to designing systems and businesses and have gone to business schools that have one truth, that every month people get paid a salary. So the velocity of cash in the MBA business model is that your customer is earning a salary monthly. That means a lot of services have been built by the financial systems to guarantee that you'll be paid. So the first thing I usually, you pay me monthly, I send the invoice. It doesn't work in this market like this, right? So the velocity of cash is different. In the African market, it works in 2 big ways. And I think the previous speaker, our colleague from Nigeria, there are 2 kinds of, there's big money that comes in lump sum with the new government, and then it fizzles out. Then there's a small money that goes every day in the market. That's sort of how money flows. And if you start working with different financial partners, microfinance, SACCOs, the art of the game is how do you design and innovate to tap into that market where the cost of payment is 1,000 shillings a day. What does that mean? That means by default, and I'm really trying to dial it down very quickly, by default, Your solution has to achieve two things in the African market for the consumer. Your customer is not the guy who pays you, but is equally the guy you have to help make money. So if you come with a solution whereby you say, okay, pay me for medical service, then you're creating liability on that third party. But if you design a system and say, okay, I'm going to create a solution where I make money, but you are also making money, it scales. And we see solutions, that's why Uber is a great example, because literally they are paying Uber, but Uber is helping them pay money. If I say, yeah, if I have to use that as an example. So we're using a digital solution in the healthcare to see if we can pull off the same game, where we're saying, if you have a healthcare bill, can we unlock the credit for you, but also help you save money in real time on your medical bill? And that's what we're doing at the platform COVA, where we're saying we can accelerate the cost of credit in this market in healthcare faster than anyone, whereby if you have a prescription or you have a lab test, we can give you access to credit through financial partners faster than anybody else. And when we have tested that in 3 markets now, Kenya, South Sudan, and DRC, 3 very different markets, the theory holds. And it makes our solution scalable cross-border. And so now we are looking at saying, okay, now how do we scale in the different markets? Because the solution is constant. And I believe that that is one of the biggest lessons, in building 3 ventures in the market.
Okay, so let's say you're a business owner, you already have your solution, and you want to scale your business. How do you pick and prioritize where to scale? What kind of market analysis do you have to do to pick where to grow to? So maybe I can ask Sandeep to take this one.
I think for me, market analysis is very critical. So as a business owner and you think that you want to move to different markets, like I mentioned, you need to understand there's several things. There's the culture. Cultures vary from country to country. I hope those of you who are cross-border have experienced that. And then there's stability in policies, and we were just having a chat with Doc earlier. You don't understand, certain countries have very aggressive tax or regulatory processes, others are a bit relaxed. How do you then penetrate those in terms of licenses and ability to then work? So that again really matters. And I think finding the right, for me, when you're scaling into different markets, it's not necessary that you must go in and start up afresh. You could think of acquisitions, even if you're a growth scale venture. It's not necessary for you to say, look, must I go and start this afresh, or can I then pick someone that's doing what I'm doing and then just work together? So I think for me, that's what matters in terms of scalability, but knowing whether your product or your service would work, that market research is really, really critical. And then what we do as well is, again, forecasting from a financial perspective. Of course, you don't expect new business to generate income in the first 1 or 2 years, but there are some who have done that, by the way. But the norm is 3 years, you're still slightly loss-making, you improve slowly, and then you should break even at least by the 3rd year. Because the revenue authorities tell you, you're not in the business of making losses. So we do need you to make profits, and then they want to tax you. But I think for a business, that should be the idea. I want to scale up. Must I go alone, or can I invest or take over an existing business or partner with someone? I've seen how manufacturers who are scaling into different jurisdictions actually use contract manufacturing, in the sense that your product is being manufactured, your name, your brand name is there in the other country, but you don't necessarily need to have a legal presence. That wipes out a lot of other complications. So I think those would be my brief comments, Charity.
Thank you. And I now want to touch up on technology and how digital tools can actually fasten your scaling process. So according to you and your experience, how has that been? How have you utilized and leveraged technology to actually fasten your scaling?
Sure, thank you. I'll dial back to the earlier question you had in terms of, first of all, understand what scaling in the African context, in my opinion, kind of feels like. The hardest thing about a business in Africa, regardless of the sector, real estate, agriculture, healthcare, even finance, is who are your customers? How do you acquire that customer? How do you reach that customer, right? Now, just think about Nairobi alone. Where do you meet your customer, right? our markets are not yet as structured as some of the other markets that we're used to designing solutions. So customer acquisition cost is the highest cost in almost any sector, right? If you, for example, this week we're doing some work with Inuka Africa, and we were training sales agents. These sales agents are persons living in the community who go out and then check and see what products you need. If you need a solar, if you need healthcare, then they enable you to access credit. That sales agent is the person who is now the sales force for the microfinance person. So the question is, how do you identify that sales agent who can go to the customer, and that hopefully is a trusted sales agent that can communicate your product? How do you incentivize? How do you compensate? How do you even put your product in the hands of that agent so they can present? That is Africa's biggest challenge to scale. What does that mean? That means when you capture that customer, you now start thinking, hey, I sold them a car. I think I'll try to sell them bread, and I'll try to sell them sugar, and I'll try to sell them even credit. You kind of have to figure out a way to really own the customer journey, in my opinion, because anytime you outsource any step in your customer acquisition process, your customer engagement process, your cost goes up, your liability goes up, and your risk of losing that customer is very high. So the role of technology, in my opinion, is basically leveraging technology to build that ecosystem around the customer. Now, we're seeing that it's not working as easily because all the big enterprises, including Safaricom, KCB, all the big banks, are saying, can we create marketplaces for customers? Because the more we keep them in our ecosystem, the better we have. So Safaricom has the marketplace app, right? All the banks are trying to create marketplace applications. And I'm sure, think about your sectors. I mean, you try and say, okay, how do we create that wraparound? And so the solution, so technology per se is not the driver of scalability from that perspective, but the question is, how can you sustainably engage that customer in a way that makes you profitable? Now, what we are doing is saying, okay, well, when we acquire the customer, we have to make sure they get the service. We have to make sure that we do a lot of customer engagement. Through the credit partners, for example, looking at with Mkopa, can we embed the solution in the phone? So when you take your phone credit, you have access to a doctor on the phone. So we are really thinking about innovating along those lines. We have to push the envelope. And then hopefully at that point, you then now start dealing with the mountain of regulatory issues. In this market now, particularly in Kenya, with the Office of Data Protection, right now, if you buy an email database, a phone database, you can easily be reported to the Office of Data Protection. So doing what other people are doing in other markets, where you're using AI bots to do calls a day, you're doing it really pushing the envelope in this market. So for example, we bought a database of 250,000 phone numbers. We have an AI agent that can call and communicate, but then the question is, can we do that without a regulator coming on board? Depending on the sector it is, when you're trying to do wraparound service, the more wraparound service, the more regulators you're dealing with. So now we have to deal with the Central Bank of Kenya, we have to deal with the Ministry of Health, we have to deal with the Office of Data Protection, you have to deal with the Revenue Authority, you have to deal with, the Labor Office. So at every stage of your product design, you're introducing a new regulatory partner, right? So it is not easy. And I don't think technology per se is the answer, but the question is, how do you design the technology to create that stickiness? So on the one side, you manage your regulatory, you minimize your regulatory exposure. On the other side, you improve the customer, you own the customer cash flow experience so that you can get paid.
Yeah, and I'm so glad you mentioned this. And I think because you're in the healthcare sector, what are some of the toughest regulatory frameworks you've had to maneuver, and how did you navigate that?
In healthcare, we are buried with regulation. Right now, for example, we use AWS, and so when you present to government, they say, where does the data reside? Really? Where's AWS server in Kenya? So we can leverage AWS, and if we can leverage AWS, that means we can scale as an African business, right? Now, So when you think about it, healthcare, the question is domicile of data is a big question we always have to navigate. Patient communication, patient rights. You need to get permission, consent from the person before you share their data, right? So there's a cost of getting that permission. So literally, digitization is against us in healthcare because of the privacy constraints, right? So there's opportunity there, right? And now, as an organization that is also integrated with the credit markets, we then also have to meet the huge regulations around financial data. So there's no easy answer to it. I would hate to pretend. You just, in my opinion, take a risk, and then if you get caught, you manage that risk down the road. But you got to keep moving.
What would you say is your one tip on how to navigate it for the business owners here, especially in healthcare?
I'm quite biased by product. So I believe that right now, the market has been sold a solution that is foreign. The market has been sold a solution that access to healthcare would come from insurance. And insurance, by definition, is a very, very costly product. The distribution of insurance attracts a 20% margin from the broker side. The cost of claims administration adds 15% to care, and insurance imposes that you must get care at a facility because you need your fingerprint. So if you look at that, the cost of distributing insurance, outpatient insurance in this market is 135% of your premium amount. What has that done in the market? It has forced two things to happen to the customer. One is that the insurance companies are forced to control and limit the care you have, or increase premiums at a rate of 35 to 25% per year, which has nothing to do with the cost of goods. It has nothing to do with what treats you, the pill or the lab reagents. It's about how much overhead. And so as you have the cost of the overhead growing at a rate of 35%, driven by cost of energy, real estate, all the networks, the hospitals, that's overhead that we're paying for with our bills. With that growing cost, the insurance model has failed or is under tremendous constraint, whereby 22 private insurance offerings in the market are failing. So we really have to look for a way to make healthcare affordable that solves two questions. How fast can you get a patient to get credit when they have a medical need, and can you lower the cost for them? And that's what we're hedging our bet on as a company.
All right, thank you so much. I want to come back to Sandeep. And when you were talking about market analysis, you did mention collaboration. And as someone who works as a stakeholder engagement officer, I know how important it is to leverage the partnerships that you have. In fact, I did see a quote that said that partnerships are often more important than capital. I don't know whether or not you agree with that, but could you share a story of a successful collaboration and how partnership is important, especially if you're trying to bridge that gap?
Yeah, thanks for that, Charity. I think before I get to the story, overall remarks for what Doc was talking about, there's a significant trust deficit between government and entrepreneurs, that I can tell you for a fact. A lot of entrepreneurs, not just in Kenya, because I've looked at it from an African perspective, is entrepreneurs or taxpayers are asking, are policies and procedures put in place to squeeze me, or is it to enable me? And I think that's what you've just talked about. So there's a significant trust deficit that we do have in and across Africa. And I think the other point around data protection, let me tell you, Doc, it goes both ways, right? While you find it as a major challenge in growing or scaling your business, I've seen it, and I've personally used it against Revenue Authority, whereby they wanted certain data of directors and beyond. And we say you're not allowed to do that based on the Data Protection Act. So the Data Protection Act protects you as well, but yes, does it cause a hindrance? Of course it does. And I think for me would be, how do we as entrepreneurs then lobby for changes, certain changes? And AI is a good way. I also get these messages on my phone, and they ask me if I want to opt in or not. Then in itself, for me to say yes and I've opted in means that you have access to use my data if you so wish. Coming back to partnerships, I think for me and collaboration, it's a double-edged sword, right? I talked about, if you're trying to move to a different market, don't go alone. I mean, think about, going as a JV or an SPV. A lot of the challenges I've seen, and I'll talk just about two. One is the governance structures. So we get along, we are friends, and we say, you know what, let's do this. You're in Tanzania, I'm in Kenya. Let's go together. And this is a real thing. Huh? I'll not take the name of the business. I didn't quite succeed. But we know each other. All right? Good friends. I have something and you have something. We have synergies. So you say, look, I'm a bigger fish in Kenya. Can I help you with, clients? Customers is key, right? Who are also in Tanzania, but I don't have a presence there and I don't want to get stuck into these tax and regulatory impact. And the other person says, yes, sure, let's go forward. This is a verbal discussion. I have agreed with you as two people. They call it a gentleman's, I don't know why, but I don't know what else to call it, but let's call it a gentleman's agreement, okay? And they go forth, and then a year later, you have issues. Money is a big issue, right? Guys, I don't know, those who have co-founders or know businesses that are two or more than two shareholders, the shareholder dynamics are so significant. So you could have chemistry initially, but when the business does accelerate, and this one did, now it's about, hang on, how much was your shareholding? This business is owned 100% by me in Tanzania. The SPV is not on paper, it is verbal. I have agreed, you send me back 50%, I will share an invoice to you. So I think that for me is the downside of partnerships in terms of, can you get your shareholders agreement in place? Let's have a proper way of exiting. And in most cases, we have helped include mediation clauses. You could be friends today because you're starting up and building a product together. In the future, when you have someone pumping in $100 million into your business, you're like, hey, I want a Lexus. I want to buy my family, my wife is saying I need a house. This money is ours. Let's extract. And the other guy goes, no, let's not extract because this $100 million is for the growth. Let's scale the business. Let's invest in the databases. Let's invest in technology. Let's invest in new markets. But you say, hey, I worked too hard, too long. I've suffered. I've been eating raw bread and margarine for a whole year. Let me go and buy some good things for myself, So I think once you have that back office and the governance structures in place, that would enable you to scale up. So partnerships do work, but with the right governance structures, the right understanding that, look, let's go in this together, but this is how we're going. And if you want to exit, the first right to buy back should be mine as your co-shareholder or co-founders. And that's how it works. So I think for me, that's an actual story. The business itself then collapsed because the shareholders could not agree. So sad and really unfortunate. But I think business people, entrepreneurs, someone else saw the idea and has now picked it up. It's now alive and kicking again in Tanzania. And even the Kenyan business just dwindled away. That focus really mattered.
Yeah, and I'm glad you've called it a gentleman's conversation. I wanted to ask the ladies in the audience if we have a female version of that, just for gender parity. But thanks for sharing that. I also want to pose the same question to you. If you could share how your experience has been in terms of collaboration, partnerships, and scaling.
Yeah, thank you. My experience, it's a bittersweet experience. My first company, actually, what forced me to sell was because, of partnership disagreement. So it's sort of expected these days, right? And business is a lifestyle. It's a choice. And in that case, my then partner, business partner, got a major contract with government, right? And took all my developers into her new business, and literally I was left with a shell, right? So it happens. These stories are real, and the more we tell these stories, the better for us. The challenge is that we don't talk about it, right? So we hide thinking that we are the only ones. It happens every day, regardless of the size of the company. It happens. And also, I'm sorry to say, and with all due respect to what Sandeep just said, paper is not good enough. Because you can write those papers. At the end of the day, the question becomes, there are just some truths. Did you put in the effort, right? And so if you have a paper that says you take 50%, I take 50%, if I put in all the work, then there's going to be a conversation to be had, and the conversation is not going to be pleasant. And that's again where the trust comes in, right? And Marjorie's in the room, they can tell, putting that shareholder agreement is a very expensive undertaking. By the time I come to Marjorie and say, hey, give me your bill to put us a house together, we don't even have the money to pay Marjorie. And that's where it starts. So Marjorie say, okay, when you guys are ready, come back to me. And that readiness never happens because we go back and try to run the business. And by the time we're coming back to Marjorie, it's too late, right? So those are just the realities of the partnerships. But they do work. And in my opinion, the question becomes, which partners help you reduce liability versus which partners create liability for you, right? And you have to be square and be clear about that. Having partners right now in this market around access to credit is a critical partner. If you don't know who to call when you have an order, then your business is really, really fragile because the banks can only move so fast. Last week we had a situation, literally, I had to call all my friends to say, I need you to kind of sort me out because the banks could not move fast enough, right? So really, who in your network can help you offset that? And that's where I think the diaspora has a huge role to play. If we can quickly tap into the diaspora to move cash, we're going to be in a good place. And now there are platforms, for example, Sidecar. We put a syndicated round on Sidecar to say, okay, can we quickly raise $100,000? That means we're looking for 100 diaspora folks to put in $1,000. And it's a Sidecar, it's a Delaware-based entity. And we couldn't get. Well, there's work we need to do, but I see those kinds of partnerships are the kinds of partnerships that we truly should really think about as entrepreneurs and how we leverage the diaspora. The good thing is that those platforms, where literally you put in your name, the deal is online, the legal terms are online, you move money into an account, it is paid to us, and literally the share transaction happens. They are there, but we are yet to use them in this market. In the US, we're seeing that it's picking up. A lot of the Silicon Valley startups are using those syndicated platforms, very similar to GoFundMe, to raise money very quickly. We're yet to do that in this market. And I believe that the business partnerships would always be, but the access to credit market is one that we can control and or improve and deploy capital much faster for us to respond to the needs in the market.
Wow, there seems to be a very big underlying theme here of trust. I think in the previous panel discussions as well, it came up. So I want to ask Sandeep, what are other pitfalls that you've noticed in your experience with, companies trying to bridge the cross borders?
So I talked about one of them, which is really that shareholder agreement. And Doc, you're right. Paper is paper, but legally enforceable, and that's where it is. And I do agree that it depends. High-end lawyers might charge more, but I'm sure, the services, legal services are quite a number. And like KPMG, we make an investment, and you have the VCs. Some of them, I see them here in the room. They can attest to that we have made an investment by not charging that premium fee. We have said, look, we want to be part of this ecosystem to help you grow. So that was just the one comment. But documentation, legality, guys, really, really important. Chemistry and how you then work it out later. Mediation is always the first option before you go to court, but a lawyer needs to be involved. You can talk to the lawyer nicely. I'm sure, they're willing to understand. Right, so I think for me, one of the pitfalls is that whereby the documentation is not good because it's based initially on trust, but then you build and you raise, and then the money is kaching in your bank account. Then you're like, okay. And then the other one is obviously, and I think Doc, you alluded to it as well, is about your strategies. So while you could be initially aligned, how then do you grow the business? Because strategy has to be continuously evolving. What worked for you 12 months ago will not work for you, and I think you also mentioned that, into the future. So you need to constantly evolve. The challenge that I have is sometimes I see the founders, two of them, they come together, or three, then they can't align on what needs to happen for the business. One would say, look, Nigeria, great market. I've done a Google search and ChatGPT has told me this is where we need to be. Guys, this is your more aggressive founder. And then you have the conservative guy who says, we have not even broken even here, guys. Where's the money coming from to go invest in Nigeria? Really? And then you have the third one who's always like, I'm on the fence on this. I want to grow, I want to scale, but this guy is right. We have not even broken even here. Have we really tapped into this market before we start going to and you know, expanding more or expanding rapidly, and you're not ready for that. So that's also one of the challenges that I've seen, whereby some businesses, they do expand rapidly, but then they fail because they were not ready for that market. So that, Charity, would be my summary of some of the key pitfalls that I've seen.
Thank you so much. So one last for you, Dr. Moka. I wanted to have you at least share with the entrepreneurs here, how can they easily structure themselves, or what strategies can they come up with to access funding from the diaspora?
I think the diaspora is the sleeping giant in the ecosystem, right? Because the diaspora, the good thing, at least the folks in the diaspora have engaged, you can set up a Zoom call. So access to them is relatively convenient across time zones. They understand systems. The challenge with the diaspora is they are not setting themselves up for us to deal. Let me give an example. If you are in London and you want to send me $10,000 and you send it to my account, right? The question becomes, how does Carrie interpret that transaction, right? And I think we had a session, end of year session with Tara Agility. That's a very complex question. So the question becomes, how do we deal with each other? So you should either be able to set up a Kenya entity so that at least the conversation is local and not cross-border, or I set up a London entity. One person has to make the move, right? So far, it is us, the ventures here setting up Delaware entities, London entities, Mauritius entities to enable those transactions. So it is not as easy as it looks. And I think Marjorie can advise on that. The trigger point is not a very big trigger point. It's $1 million shillings or thereabout. It's not a huge trigger point. So we really have to do that. And then if you give me debt, for example, one of our funders, we're paying interest, and it's an institutional fund. We had to pause even paying of interest because each interest we paid attracted tax liabilities to the tune of 25%. And we realized that after 3 or 5, we haven't got one of the auditors. So Sandeep, you're right, we have to be careful. So cross-border work is not easily. So the long and story is that one person should commit to be on the side of the fence. Either you jump on my side and you set up some sort of a Kenya structure so that you can move money to me and I can pay you back, which is what we did with one of our partners from the Middle East. They created a Kenya entity. We pay them locally. It was a dividend-based structure where we pay them per transaction. And then they move the money. I don't know how they move the money. I don't need to know how they move the money, but they do move the money. And we've had a beautiful partnership now for 6 years with no friction, right? So I want to say that, yes, we're in the diaspora, but at the end of the day, one person has to be local in the other person's jurisdiction for business to happen. And then you trust us to really now make some of the local decisions. The other thing I really want to encourage those who want to set up their own business is the beauty about the African market is that I believe very strongly you just need to be 1% better than your customer and you can really, really make a move in the market. That 1% rule applies very, very strongly in this market. Secondly is that invest in the need and forget about scaling for a little bit. And that is what saved me in the third business because I set a very clear goal. Until we get to 10,000 customers, I'm not taking equity and I am not talking about scale. And until our unit economics are right, I am not inviting somebody into the business. Why? Because The issue is you take money too early and you owe people. And that is, at that point, you owe the person, pay them back. So resist the temptation of taking somebody's money until your unit economics can back that conversation. And if it's debt, make sure that the assets can give at least 10x return. If it is equity, really be asking yourself, can that $1 give that person $20 in 6 years? If you cannot have that conversation with yourself, please do not mess around with diaspora money, or anybody's money for that matter.
Yeah, thank you so much, Dr. Moka. 1% better, you said. I would really love for us to continue this conversation, but in the interest of time, I wanted to ask you both to share in one sentence, what is the #1 success factor for building a truly cross-border African venture? Maybe we can start with Sandeep.
One sentence? That's not a paragraph, right? Okay, great. I think for me, a successful venture would be based on trust, credibility, and obviously access to finance. So with those three is how you then scale up your business. And I think Doc talked about access to capital, and allow me to share a small story if you don't mind. I'm at a PE, and he was saying when he was investing in a South African business, the South African founder was so keen on the shareholder agreement, the buy-sell agreement, the KPIs, no, this, I can't do this, this may be, but this timeline doesn't work out for me. But the Kenyan founder is like, where do I sign? Put the money in the bank, So I think that kind of dynamics is also very important. So don't be too quick to take money. And also when you feel like when you are taking investor money, we have European standards. And I think that doesn't work for the African market, diaspora or not. You can't, investors cannot expect a return of 10 times. They can't expect to exit within 5 to 7 years. Does not work for the African market. We need patient capital. And that would help us scale. So I'm going to take a pause there. Thank you, Charity.
Thank you so much for chiming in and adding on to what Dr. Moka had mentioned. So if you could also in one sentence tell us what is the one success factor?
Figure out your payment. Payment is difficult in this market. The deal goes through and it just, the transaction goes through and falls at the last minute just to pay for a good or to receive money from someone. Let's not be deceived by the convenience of M-Pesa. It's very convenient for small transactions. Once that you start getting to a certain threshold, moving that money, getting paid. So really, if you're thinking about into another country, really figure out, first of all, if let's say you had $10,000 sitting in an account, how you'd move that money. Once as you understand that, it will really inform your pricing, it would really inform your cost of credit, and if you do not know those two, even your pricing based on cost of goods will be wrong, right? We literally had to redo a whole pricing and a whole banking strategy in South Sudan. Delivering the service, setting up the supply chain was easy. I thought it would be difficult. How do you really create, and you need to figure out which is the right bank where you want to put in the money so you can move it. And so I would say, think about that. If you're in London and you're putting money here, if you're going to redeploy the money here, have a plan. If you want to move the money back to London, think about that.
All right, thank you so much for your insightful conversation. A round of applause for our panelists. Yeah, please do engage with them after and get to connect with them. That's the end of our session. Thank you so much.